Hey guys, Kevin Bupp here. Before we jump into today's episode, I've got an important heads up for all accredited investors that are tuning in today. You probably know that my real estate investment firm is Sunrise Capital. And today my big news is that Sunrise's Fund 4 is closing in a few days, on September 30th to be exact. So if you're an accredited investor and want to get access to immediate cash flow, as well as growth and tax advantages offered by Fund 4, go to investwithsunrise.com. We're wrapping up Fund 4 with one heck of an acquisition. A 6-asset mobile home park portfolio in the booming Columbus, Ohio area. This deal is pushing our built-in equity across the fund to more than $25 million. Plus, this deal alone has huge tax benefits and is likely to add another $20 million in depreciation benefits to all Fund 4 investors. But you have to get in now to take advantage of those benefits. Fund 4 will close out with 15 performing mobile home parks and parking assets, delivering immediate cash flow, long-term growth, and significant tax advantages for this calendar year. So if you're an accredited investor and interested in seeing if it's a fit for you, go to investwithsunrise.com. Again, that's investwithsunrise.com. Now, let's get to the show. Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, today's guest is no stranger to the show here, as I've had the pleasure of knowing Joe for well over a decade now, and I've been able to watch him grow his company, Ashcroft Capital, into one of the most recognized and respected multifamily investment firms in the country. Since him launching this Ashcroft back in 2015, he and his team have been able to acquire over $2.7 billion in assets, and they serve thousands of investors nationwide. In addition to that, Joe is also the host of the Best Ever Real Estate Investing podcast. In fact, I think Joe and I, we sometimes probably get labeled as OGs because we've been doing it for quite some time. And we kind of date ourselves there, Joe. Sorry about that. But yeah, we've been in the podcast space probably before even some folks knew what a podcast was, right? But, Joe, over the year, Joe he's been on our show multiple times, but I think today's conversation that we're going to have is especially timely. The last 3 years have tested commercial real estate investors as well as multifamily syndicators like never before, really. A lot of folks at this kind of their first cycle that they've gone through. Rising interest rates, slowing rent growth in a number of markets, oversupply in certain markets, and variable rate debt, debt maturities, lots of things that really culminate into hard decisions to make as you continue to grow and operate a business. And so, Joe, we talked about this before we started recording here. We're going to talk about how Ashcroft has navigated some of these challenges. What's worked, what hasn't, and what he sees ahead for the multifamily sector here in the coming years. And so, Joe, my friend, welcome back to the show. It's always a pleasure to have you here.
Well, looking forward to our conversation. And I was going to ask you how long you've been doing this podcast, because I remember speaking to you when I was in New York City in my apartment that had this 2-bedroom apartment. I always had a Craigslist roommate. No, there's no living room. It's just a dorm style size fridge. I lived in it for 9 years. And I remember our conversation. So how long have you been doing this?
January 1st of 2014 is when I
Yeah.
officially launched the first show. And the funny part of that story is I bought all the equipment about a year prior, dedicated
Hmm.
one of the rooms of our house, which was going to end up being a bedroom for our second child that wasn't here yet. Was just in the planning stages, and I built. Back then there wasn't a lot of resources on podcasting.
Yeah.
What kind of equipment you use, and most of the folks that were teaching it was they came from the audiophile world, right? And so it was like you need mixer boards, you need this, that, and the other. And I built
Hmm.
out this room with sound deadening material, and I bought all this equipment, and then
Oh,
it sat there because I was so overwhelmed about what the
yeah.
hell do I do with this? How do I operate it? And
Mhm.
and then my wife gave me an ultimatum about 11 months later of either you turn that room back into a bedroom, and I'm going to sell this stuff on eBay, or you start the podcast that you've been talking about for the past year. So I started the podcast,
Yeah.
and here
Oh
we are,
man.
many
Yeah.
years later.
Thank goodness. Hey, sometimes ultimatums work.
That's right. That's right. Yeah,
Yeah.
yeah. A lot of times in marriage, I wouldn't suggest it, but that was a
Right.
good one.
Yeah. That was a good strategic use of an ultimatum on her
Yeah,
part.
I agree. I agree. Well, good to see you again, my friend, and I'm excited to have a conversation here with you today. So why don't we just jump into? I'm just going to make the assumption, which, I don't often do, but I'll make the assumption that most folks know of you. They've heard of you. They've listened to your show. They've been to your events. One form or fashion or another, they know who you are. So we're gonna skip the background part. I know we're a little bit on a condensed timeline here. So let's just get into the meat and potatoes. I mean, why don't we start with more of a macro view of, I guess, how you would describe the multifamily investment climate right now compared to a few years back?
Compared to a few years back. So the
Like prior to,
climate,
I'd probably say, pre interest rates, shooting up at all time,
oh,
record pace.
yeah, I think you've got three stages based on where we're at now, and we're in the third stage. I'm not saying the third is the final stage, but I think we've hit three different stages. The first stage prior to interest rates is euphoria. Everything's working out. Interest rates are low. Debt's plentiful. Cap rates are compressed, and the new supply from the lower interest rates that penciled had not hit the market yet. So
Hmm.
you had higher rents and limited supply. Then the second stage would be what we have been in for the most part up until I'd say it depends on the market, but I don't know, last quarter or so, and that is the opposite of what the first stage was. Higher interest rates, as you said, all those things. Yeah,
Hmm.
higher interest rates and hyper supply in most markets, and um, elevated expenses and floating rate debt. That rate caps when they were $30,000 initially are now $1.2 million when you go to renew a rate cap. So that's the second stage that we've been in since since they started hiking interest rates. Um, and now I think we're entering this third stage. And the third stage is, if you think of just like, a, a, a pond and the water is really stagnant, uh, you've got a trickle of a stream that's coming into the pond to start to get the water moving again. It's not flooding. It's not flooding the pond, but there's a steady stream that is starting to clear out all the stagnant nastiness. I'd say that's where we're at.
Okay.
2025, according to a lot of sources coming into 2025, was supposed to be when we saw rents increasing, and was supposed to be when we saw supply or the new construction concessions taper off. But that hasn't really happened. And again, I'm
Hmm.
talking generally speaking. Obviously, it's market specific, it's submarket specific, it's A, B, C, D class of apartment community. But just generally speaking, rents haven't gone up. They've remained flat or decreased. Some in some markets, some submarkets, they've gone up moderately, or just slightly, I should say.
Hmm.
But what's happening right now is it's kind of a stalemate because um, rents haven't gone up and because supply is still trickling through on the lease up. uh, the valuations aren't there for the sellers to sell, and the people who are buying, they want the pricing to be lower. And so that's where we're at right now. And I think uh, based off of just supply demand, I see that I think the supply is going to start to restrict again once all these new construction deals are leased up and the
Hmm.
concessions burn off. But it's going to take a little bit longer than what we thought it would take.
Yeah.
And
It,
so that's where we're at right now, is that third stage.
no, I appreciate that. And just for some additional context, different markets? I know I believe Atlanta, Georgia is a big one for you. I know Dallas is another big one, and there's a multitude of submarkets in those MSAs. But what are the other big MSAs that you guys have a footing in?
DFW, Tampa. Well, a big footing in would be
Well, just I guess
DFW.
your portfolio. Where's it?
Okay, our
Where's like
portfolio.
the major markets
Our
where
port,
it's spread
yeah,
across?
DFW, Tampa, Orlando, Jacksonville, We have one deal right outside of Miami. We have one deal in Chapel Hill, North Carolina,
Hmm.
and then we have a lot of deals in Atlanta.
Got it. Yeah, all great markets. I just
Yeah.
curious to know, are there any of those markets you just referenced? Are there any what I would classify as like a surprise market where the fundamentals have held up better than expected or better than maybe a few of the others?
Um, DFW,
Hmm.
I wouldn't say surprise market, but as far as
Yeah.
fundamentals holding up better than the others, DFW, um, that's been that's been recovering the fastest. I mean, they've all every market has been hit with what I just talked about and what you mentioned at the beginning of the
Yeah.
show, but DFW is recovering faster than uh, some of the other markets,
It-
especially Atlanta.
it-
Atlanta, I'd say, is in lagging behind those other markets from a recovery standpoint. Uh,
is that a function of, I mean, just more population? And I don't know the data points in this, but more population growth in DFW and less new supply that's needing to be absorbed versus that of the opposite in Atlanta. Is that
yeah. Yes, that is a component of it. You also have Atlanta when during COVID had during the eviction moratorium, you know, and I'm going back 5 years, right? Like
yeah.
during the eviction moratorium, Atlanta you couldn't evict anyone even if they weren't paying rent. And then when you could evict them, uh, some of the larger counties in Atlanta weren't properly staffed to evict people. So you had
Hmm.
it was taking you, you know, 13 months to evict someone. I mean, we're talking in New York, New Jersey timeframes, right? Like, but this is in Georgia. And as a result, when you have a large portfolio and or even if you have a 100 unit property, if it's taking over a year to evict someone, that's going to hurt. That's going to hurt
Yeah.
your numbers. And not to mention, if you have someone, as you know, if you have someone living in a property who is under the eviction process, you know, how, what type of quality tenant generally are they?
Hmm.
And how are they going to, generally speaking, treat the property, the community, and what type of residual impact will that have on the rest of the property and the community during that period of time? And then when you have more than one in a
Yeah.
property and you have multiple, then there's a compounding effect. So a lot of it was not a lot of it. A component of it for Atlanta was staffing and just riding the ship. Now it has been corrected by and large, and evictions are able to move at a more timely manner than it was before. Um, but then you also have supply that hit Atlanta particularly hard from an
Hmm.
investing standpoint, and there's a lot of supply, and rents is just not kept up with what was projected on large sources like
Yeah.
CoStar, for example. So it's just it's been all of those things that we've mentioned, plus a couple other variables that are unique to Atlanta, which made it more challenging.
Yeah, that's interesting. We've owned a number of mobile home parks throughout the Atlanta MSA, and a lot of folks just kind of lump Georgia all into the red bucket, right, and just assume that it's incredibly landlord friendly, and we experienced the same thing in a number of
Yeah,
communities that we owned in the Atlanta MSA, and even some of the more secondary and smaller markets south of Atlanta, kind of the same challenges. It almost seemed as though a lot of the judges, even when the national eviction moratorium, the federal eviction moratorium ended, they kind of took it upon themselves to keep it going, right? And we noticed that in a few other states and a few other markets as well. They just selectively
yeah,
chose to keep it rolling for as long as they wanted, right, with no
yeah,
opposition. Um, no, all good. I guess curious to know as far as like what are the conversations? I'm sure they've evolved over the last couple of years, but conversations with lenders. How are lenders working with borrowers nowadays? I mean, this isn't like an isolated incident. This is this is what became a larger scale problem with just, even the best operators having challenges in their portfolios and challenges with, debt maturities that were looming, or, variable rate debt that ultimately, threw the DSCR out of whack. And so I guess how have you seen those conversations evolve over the last couple of years? And have you found that most lenders are understanding of the matter and willing to work with borrowers through this challenging time?
Depends on if it's beneficial for them to do so. I mean, that they're not
Hmm.
they don't do it out of the goodness of their heart. Lenders typically have investors, and those investors need to make money, and lenders need to get their money back. So uh, it's got to be mutually beneficial
Yeah.
for a lender to extend a loan, to defer the interest payments to the end. There's usually a pay down involved of some degree on the loan, so that they have less liability. The lender has less liability. Um, there's typically a um, yeah, there's typically a lot of back and forth, but ultimately it's just um, what I found is relationships do matter, but to an extent.
Hmm.
And then lenders are lenders, and they have boards that they need to report into, and they have investors that they need to report into. And so, I've been involved as a passive investor, as a limited partner, because I'm a limited partner on a bunch of deals. I've been involved on multiple deals where I've lost all my equity because the general partner got foreclosed on, or effectively got foreclosed on, and it's just part of it. As a limited partner, it's just that's unfortunately part of it. Um, Hopefully, there's a lot fewer of those than deals that make money, or return the capital, or make a lot of money.
Hmm.
And the deals that I was a limited partner on where that happened, um, usually there's a couple of forces in play. One is it's well, obviously the loan's typically up for maturity, or it's a floating rate loan that's just not sustainable anymore, and something needs to happen. Either the lender needs to fix it, defer the payments, defer the interest payments, or they need to get out of the loan, either through walking away, handing over the keys, or some other method. And uh, so there's a loan issue, but then usually there's a market or operational issue
Hmm.
to further challenge the deal. And that's when you've got deals that that are tough, as a limited partner, as a general partner, to navigate, because you're fighting a couple very strong forces, and you do what you need to do, to protect the investors as much as you can, and you have those conversations with the lenders, and you try to make it as mutually beneficial as possible. And that's why you see capital calls, um, and we've done capital calls for some of our portfolio, and we've extended loans, from floating to fixed, and just extending them for 3, 4 more years, which the theory is, as you have more time to uh, grow NOI, then you're going to be in a more favorable position. And oh, by the way, interest rates are supposed to decrease.
Hmm.
And with that, most likely cap rates will compress some, as a result. So, with increased NOI, and with perhaps compressed cap rates, and interest rates being lower, then you'll be in a much more favorable spot 3 years from now.
Yeah. No, that's great. I appreciate the insight there. I'd love for you to. I know I do remember now that you were involved as an LP in a lot of different deals. I am as well. You put on your LP hat and walk us through kind of your decision making process in a deal that's going sideways, where you're an LP, where a capital call has come to fruition. for you to make the decision whether I inject capital in or I just, take my chances and not contribute. How do you help, you know, make that decision? That it's a difficult one, especially for folks, LPs that, that have taken, a lot of their retirement and put it in with different operators, this, that, and the other. And it's like at some point you start wondering, do I throw good money after bad? Right. I think that's probably
Mhm.
the question that they have to answer, the most difficult question they have to answer of whether or not they're going to contribute. And so, how do you, make that decision?
I would first ask, what's the loan balance, and if
Hmm.
there's any other, debt associated to it or pref equity, what's that total? So the loan balance
Hmm.
and the pref equity. So what is that total? And then get that amount, and then ask, what's the current BOV, broker's opinion of value? And usually the BOV gives you, three different tiers, low, medium, high. So what's the medium? Well, what are all three tiers
Sure.
for the BOV? And that gives you, let's say the total debt is 42 million. There's no pref on it, so 42 million. And the BOV is $44 million. So that means that most likely all the current equity is gone. It's wiped
Hmm.
away. If you sold today, there's $2 million there. I get that, but transaction costs and whatever
Eat that
else
up.
on
Yeah.
that type of property. Um, so then you've got to take a look at, okay, currently there's no equity in there. Um, if what how much is the capital call for? Let's say it's 4 million bucks, about 10%, or I guess that would be that 10% of debt. Let's just say it's $4 million for simplicity. So the question is, one, in this scenario, um, since there's effectively no equity in it, if we sold today, um, how confident am I that they can increase the value, the amount that this equity, this capital call is in order to at least pay me back my capital call dollars. Now, what they might be doing is taking some of that $4 million, and you'll know this by simply asking them, or when they share what they're doing with money, they might be taking some of the $4 million and knocking down the loan from 42 million to 40 million, for example. In that case, I think that's a good use of capital call dollars, assuming that you get some sort of horse trading with the lender
Yeah.
to get better terms for the loan, fixed interest rate, lower payments, whatever it is. Because then you're just taking that $4 million and you're lowering it from 42 to 40, and the value is staying the same at 44. So you've got that, in theory, you've got that $2 million that was used to pay down the debt to be returned, assuming that everything stays exactly the same when you sell later,
Hmm.
which we all know things won't stay exactly the same when you sell later. But
Sure.
that's the thought process I would look at: the current debt and pref equity total compared to the BOV mid range today, and then take a look at how much is being asked for on the capital call, and then understand where's that going. Is there going to be money to pay me back should they need to sell, and they don't significantly change operations? That's the thought process from a number
Yeah.
standpoint. And then from an intangible standpoint, uh, you'll want to look at, or I'll just speak for myself. I look at, do I think they have the competency to pull off the
Hmm.
business plan that they've outlined? Because they'll have the business plan outlined, and you can easily look at the value and how much is there if it was, with the capital call dollars. But do I believe that, based on what I know of them and what's taken place so far, that they have the competency to pull off the business plan? And so I look at those two things,
Yeah.
and identify what are the, and by the way, they might have the competency to pull it off, but when you're looking at the plan, take a look at what markets, what
Hmm.
sub-market is it in? What type of property is it? Is it older property? Is it a newer property? Um, you know, looking at some of the intangibles that, or not the intangibles, but the variables that are involved, that even if with a competent operator, um, there still might be issues, taking a look at that. Um, and then taking a look at the assumptions that they made with rent growth and NOI growth. And, I can tell you that some um, reputable third-party research companies have been off. They've just been flat wrong on rent growth projections, on supply demand. And so at that point, it's like, well, who do you listen to on what's
Yeah,
going to happen and
great
what's taking
question.
place? And you listen to your team. I think you still look at those research companies, but it's not it's not written in stone by any means on what they project and what will take place, even for supply demand, which you think it would be, because
Interesting.
you have to submit permits and other things, and so you think that'd be easy to look at, but um, they were off on how much supply was going to hit the market in certain cities, Atlanta in particular, but a lot of cities that we invest in.
That's shocking.
So
You think that's readily available data, and that's a little shocking to me. But yeah, it makes sense. I guess so. So then
and we ask them,
the
yeah,
question
we
is like,
ask
then who
them.
the hell do you trust, right? How do you how do you
That's
make
right.
educated decisions?
That's right. Yeah, it's challenging. It is challenging. That's right. So you you just got to look at multiple sources, I guess, and just kind
Yeah.
of figure out what story, or what's the average, or what's the, you know, how do you want to approach the thought process whenever you're underwriting these things?
Yeah, being on the back seat, I guess as an LP on a couple deals myself, one of the strategies I've seen, of kind of the business plan as a whole on deals that have some challenges is and it seemed to be pretty prevalent in at least in a number of Texas markets, Dallas and Houston. I don't know if it was commonplace in other markets, but the tax abatement strategy where you convert a certain number of units to low income housing units. And then basically the property taxes getting permanently or not, maybe not permanently, I don't know all the language in it, but basically abated, which is typically a significant drop to the bottom line. Has that been a strategy that you guys have found any success in?
Well, that didn't work for everyone in Texas. So it's HFC,
Okay.
and uh, governor the governor of Texas signed a bill that said that's going away as of
Ah,
2026.
okay.
And there's a lot of litigation that will result from that, because you effectively sell your property, the land. You effectively sell the land to a nonprofit, and so these groups that went into it, and we started the process for some deals with HFCs, and so um, which is costly, but you go with the best information that you have, and our lawyer said it was unconstitutional, if he had signed that, but he signed it. Um, Fortunately for us, we weren't as far down as other groups. I'll give you an example. What is going to happen to a lot of groups in Texas? Um, you know, let's say you do the HFC, and then you get out of your loan, and you're at a certain loan to value, and then you need to refinance into another loan with this new valuation, because you got this HFC with lower taxes. Well, if that tax abatement goes away, you're in no man's land, and you are going to default on your loan. And that's why there's some major players, major operators, REITs, that have pursued and executed on this strategy, and they are
Hmm.
going to be in trouble,
So you're saying it doesn't
big
go
time.
away? It doesn't go away just for anything thereafter 2026, but it would
It's
even those
gone,
that made it through the process would basically
gone.
be back in up shit's creek.
Yeah, like I think it's January or February of 2026, it's gone.
Wow.
and
Yeah.
and they have new loans that were based on this. So now they're going to be paying taxes
Oh, I got you. So you're saying
and
the ones that are in big trouble, the ones that actually went and maybe refinanced, got a new loan put in
refinance
place
got
based
in.
on oh God, the increased valuation. Understood.
Yeah. And so now they're with this debt and now they're gonna all of a sudden
Oh
start
boy.
paying these property taxes and it's gonna flip the property upside down.
Wow.
Because
So
and by the way, they don't own the property. They don't own the land. The nonprofit does. So it's just gonna be all sorts of messy for those deals, and I don't, there's gonna be a lot of litigation that's associated with that.
what else could turn into opportunity though, correct? On the other side,
Good,
as far as
yeah, it
potential buying opportunities.
buying, yeah, that's right.
So I love to, as we, focus on the time here, I want to make sure I get you off in a timely manner here. I want to, flip to the other side of the equation. So obviously, really, the last couple of years have been tough, slower transactional volume, less acquisitions. I don't know how busy you guys have been on the acquisition front, but just seem across the board, I'll speak in generalities, it's been slow, right? For the last couple of years, you know, I guess speaking from an operational standpoint, it gives you a lot of free time to really dive even deeper into operational strategies and, just really trying to find pivotal moves within the organization where you can continue to drive revenue, drive the bottom line. Has there been any notable changes you guys have made? Because I believe correct me if I'm wrong, your property management's vertically integrated, correct?
Correct. Yeah,
Okay. Have there,
we have our own property management company
yeah.
called Birchstone Residential, and as of now, they only manage our deals.
Yeah, have there been any just pivotal changes that you've made that or implemented that have had an outsized impact? I mean, or substantial impact within the operations side of the house. So, again, more specific over the last couple of years.
Uh, we've gotten tighter as a team, and we've actually hired some more regionally focused directors for our markets, uh, because it's we wanted closer people geographically closer to the markets than what we had before. So we have a woman who oversees our Atlanta portfolio who's based in Atlanta, and whereas before it was more of the Southeast,
Hmm.
and so from a hiring standpoint, um, we've gotten our team members a lot closer to the deals and to the properties. And then I'd say actually, so my area of focus within the business is investor relations and investor
Hmm.
services and in marketing. And so if my business partner were asked a question, then he would be able to answer it much
Understood.
better than I am because that's his focus, whereas my focus is what I just mentioned. So I'll say through artificial intelligence AI, we have been focused diligently on optimizing our process to um, help streamline things. And you and I were talking about it
Hmm.
prior to recording. Uh, uh, it 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 is some AI is happening now, and if you are not on board, then you're being left behind from an
Hmm.
efficiency and effectiveness standpoint. And the benefit of adopting AI right now in the business is that not, I would say the majority of the competition is not adopting it the way it could be adopted. So you'll have a competitive advantage right now.
That's right.
So a couple things that we're doing. One for each deal that we have, we're working on specific custom GPTs where the IR team member, uh, let's say the deal is called ABC Apartments. Well, you can put in all the information about ABC Apartments that was in the offer memorandum, that was in the investor, marketing package, and then feed it the monthly updates. We send monthly updates. Feed it the
Hmm.
monthly updates, and then feed it the questions and answers that you give. Questions that investors ask and answers that you give, and have it know that deal very well so that when you're on a call with an investor, then you simply go to that specific custom GPT and type in the question and it's giving you the answer, the pressure of what you've already asked, what you've already answered. So we're
Hmm.
working on that for each of our deals, and that's going to be a really good time saver. And then we're also working on um, a research that allows us prior to the conversation with the investor. It allows us to have some good research on the investor that's automatically done for you. I was on the call with Vanessa Alfaro, who is very, very smart and uh, savvy and cutting edge. Cutting edge is what I was looking for with AI
Hmm.
specifically. And she was telling me that, hey, typing in a search for something in art and Chat GPT or Perplexity or whatever, that is so 2022, 2023. Really. She said, yes, having an AI agent, having a workflow done for you so that it presents what you want. For example, if you have a conversation with someone, if you're going to have a conversation with someone, instead of typing in, hey, I'm going to talk to so and so, it ties into your calendar already. And then it knows who you're going to speak to. And then it automatically gives you a report prior to the conversation that's sent to you. Um, that is no hands-free approach that AI
I love
is
that.
going to deliver to us. Now, I am not there yet. Others are, and I strive and for my team and I to be there soon.
Yeah, no, I love that, and we talked about this obviously, but it's kind of the same thing. We're looking to really embrace AI and throughout the organization. I guess the one question I might have for you, there's a couple areas where you mentioned where you're leveraging this technology inside the business to create efficiencies. Um, Obviously, there's like this endless world of what AI can potentially do. There's many different departments within an organization and then sub departments, and there's all these. I guess the question is, how do you choose where you want to spend your time, right? Like it can become overwhelming when you
It
start
is,
once you understand the basics of AI and the power behind it. You start looking at your entire company and saying, we could use this everywhere, right? But that it
yeah,
takes time,
that's
energy, and focus.
exactly, that's what we are. It's interesting. We're doing EOS through
Hmm.
in our company, and uh, what the integrator uh, who oversees things, she is responsible for incorporating AI within our business, and that's what she and I were talking about. There's so much stuff, and so that you could do, it can be overwhelming. So what we did is we took a giant step back and we thought, what are the biggest problems that we have right now?
Hmm.
And then how can AI help us solve those problems? And so we started from what are our needs and then using AI as a tool. Uh, and that's how we're prioritizing things versus starting with AI, which is the bottomless pit of all sorts of things, and then figuring out, okay, well, I like this, I like this, I like this. That's the approach that we've taken, and that's I think the best approach to take.
Yeah, that's a great point. I mean, just using the EOS nomenclature and IDS, right? Like where you're solving issues and trying to find what's the common theme. If you can look back
Yeah,
historically, what has been the common theme? What are the issues that commonly come up to the top and are discussed inside those meetings and starting there, right? That'd probably be an easy path to get.
yeah.
Um,
Another easy thing to think about is what are the activities that myself or my team do on a regular basis that are repetitive
mhm.
or administrative burdensome administratively, because those are the activities that are ripe for AI automation so that it removes the human and it allows the robot to take over and do it automatically so that it removes the human error
Yeah.
and just elements.
I was last week. I was dropping my boys off football practice, and they begged and begged that I would stop by and get them a hamburger from Wendy's on the way there. And I don't necessarily support the fast food business, but in any event, I stopped. I caved like father a lot of times does, and I got them a hamburger and was shocked that literally I was talking to a bot. It took my
Yeah,
entire order. I mean, there were people there
yeah.
handing it to me through the window, but that's the first time and maybe that I don't go to fast food restaurants often, so maybe that's existed for quite some time, but that was shocking and it
It's
was accurate. Even
they
like a special order, like, no cheese, pickles on that one, no pickles on the second one, no, like there were some specifics in there that 50% of the time the order taker would have actually gotten wrong, and this got it
Yep.
100% correct. So,
There,
uh,
I will make a prediction that, well, one, before I make the prediction, they could automate the whole
yes.
restaurant, like Wendy's. There could be zero people in there. I'm confident that that technology and that ability is there now.
I think it's just too much of
And
a
I
PR
also
blowback to do it all at once, right? It'd be
I
too
spec
shocking to the
exactly.
world.
I speculate that's why they don't do it.
Mhm.
Jobs, PR blowback, but there will be a fast food restaurant, whether it's a brand new one or a current one, that does it. And then once they do it, then it's like Roger Bannister, right? Like the
Yep.
4 minute mile, like then
Yep.
the dominoes will fall, and that's going to be automated because it could be automated.
Yeah, no, I agree with you. No, great points there. And I want to, again, I know we're trying to wrap this thing up here, so I don't want to rush out, but I want to, we were talking about AI. I know that you've got a new show that's coming out. It has not been launched yet. You want to take a minute to just make mention of that here to the
Oh,
listeners?
sure. Yeah, yeah. It's I forget the title of it, but who cares about the title? It's how to do things with AI in commercial real estate.
I love it.
So if that's not the title, that's what it should be. And it's going to be um just subscribe to the podcast, the Best Ever CRE podcast, and when it's launched, you'll be notified. So much is talked about AI conceptually, what can be done. I'm tired of that. What I want and what I'm doing with this show is a video show where guests literally walk us through how they do a
Hmm.
specific thing with AI that helps practically speaking for the listener. Like,
I love it.
how do I create a workflow for automation on that research that I just shared with you? Or, how do I do underwriting analysis and through AI.
Yeah.
So it's a how to do things with AI, not conceptual stuff.
I love it. I mean, it's just, I think it helps eliminate the overwhelm, right? Like, show me the mechanics step
Yeah,
by step of how to do this. Show it to me one
that's right.
time, and ultimately, again, one step and one foot in front of the other. So, but yeah, there's lots of theory out there, and it's very difficult because again, this is so new and so overwhelming to the average individual, myself included, that I just need to understand the practicality behind it in our day-to-day operations, what we do day in and day out, and how do I apply it, right? And then you start looking at all the various tools. ChatGPT is a common one, but gosh, there's so many new AI softwares coming on the marketplace that becomes overwhelming in itself. Like, some do this better than the others. It's like, where do I focus my time and energy? I've only got so much of it, and I'm already
Right.
overwhelmed with what we're doing running the organization, but I want to allocate time on a daily and weekly basis to better understand AI and start implementing it into the business. But how do I do it? And it sounds like we're going to learn that from your show. So I'm excited for that, buddy. That's awesome.
Yep.
I love the targeted focus, especially with commercial real estate. And so I'll definitely watch out for that coming out. And that will be on, just to confirm, that will be on the same
Yeah.
RSS
Yeah.
feed
It might.
as the show.
Yeah. It might end up being just on our YouTube channel, but
Okay.
we're gonna announce it through the podcast, the Best Ever CRE
Okay.
podcast, when it's live. If you go to bestevercre.com and just join that newsletter, it's a really good newsletter that gets sent out every week.
Mhm.
You'll be notified through that too.
Okay, awesome, buddy. Well, Joe, it's always a pleasure catching up with you, my friend. I'm gonna let you go now, get to your other appointment, and but it's always great having you on. Good catching up, and look forward to that show coming out and catching up again. Hopefully, sometime in person at a conference here in the coming months or years.
That's right. Hey, good seeing you again.
Alrighty, guys, that's all we have for this week's show. And until we meet again next week, this is your host Kevin Bupp, wishing you huge success. Take care now.